Hi everyone, welcome to the Buffett and Beyond Stock Selection Strategies. And remember, if you want to live on the beach like Jimmy Buffett, you've got to learn how to invest like Warren Buffett. And we will teach you how to construct your own portfolio through the use of our podcasts, our daily market letters, our weekly video stock analysis, and our proprietary computer program. Hi folks, this is your host, Dr. Joseph Belmonte, along with Debbie, and that's Debbie with a Y, and all the questions she has from our listeners out there in investment land. And before we get to our podcast today, if you want a free sample of all our materials, just go to our website, buffettandbeyond.com, and sign up for our 30-day free trial, which contains all of our information along with access to our computer program. And remember, it's free for 30 days. So yes, we will teach you how to invest like Warren, but you've got to figure out how to live like Jimmy all by yourself. Buffett and Beyond proudly presents to you the good, the bad, and the ugly. And remember, folks, the good stocks should be in our portfolios, the bad stocks should be in somebody else's portfolios, and the ugly stocks should be in nobody's portfolios. Debbie, what's our very first question of the day?
Hello, JB. Hello, everyone. Well, our first stock is Salesforce.com, which is a leading provider of an on-demand customer relationship management, CRM services, and it offers services to manage and share information regarding sales, customer service and support, as well as marketing operations worldwide.
Well, I'm not sure I understand what any of that stuff is, but we'll look at the numbers and we'll see what the numbers tell us. Well, first thing we're going to look at is the clean surplus return on equity, and you folks all know that in order to get into our growth portfolio, that we want to see a clean surplus return on equity of 20% or greater. And also remember that the average stock in the S&P 500 has a clean surplus return on equity of 14.5%. Now, as you can see, Salesforce.com does not meet those criteria. But, and this is a big but, look at that clean surplus ROE starting in 2016 and coming up to 2019. And we can see that the ROE is going up. Now that means that the earnings are increasing each year, but they are increasing at an increasing rate. And that's very, very important because the market loves that. That means the company is growing. And when we look at the revenue growth over here for 2019, it's revenue growth of 13.6% and net income growth approximately 13.6%. So the company doesn't have a high ROE relative to our desires. However, it has a rising ROE and the market likes that. So let's look at the past 12 months and we can see this rusty colored line is Salesforce, and we can see that it is way outperforming the S&P 500 by a long shot, folks. And when we look at the past 5 years, we can see that it was marching along for the first 3.5 years or so, about even a little bit ahead of the market, which is a little bit surprising. But with that ROE rising, then all of a sudden last year, the market just began to love this stock and it started going up. And this year, 2018, this stock is just taken off like a rocket. So let's get right on to our next stock. Debbie.
Alrighty, JB. Our next stock is the maker of some of our favorite nutritious foods. I'm not sure about that part, but Hostess brands with the stock symbol TWNK.
I wonder what that stands for.
I wonder. Hostess brands manufactures, markets, and distributes baked sweet goods in the U.S. Popular products include the Hostess cupcake, Twinkies.
Ooh,
yeah.
That's where the stock symbol comes from.
Ding dongs, donuts, ho-hos, Suzy Q's, fruit pies, and singers. And prior to November 4th of 2016, the company was privately held.
Yeah, and I can remember we were doing this on the radio show when this company was taking private, and we thought it was a pretty good company at that time. But folks, when a company goes private or is taken private, usually the buying company then finances everything with all debt and then sells it back into the marketplace, and it keeps all the equity. So it's a pretty good deal if you could do something like this. Let us look at the latest numbers. And of course, we only have numbers since the company went public again, just about 2 2.5, 3 years ago. And again, we can see that this ROE is rising way below the 14.5% of the average stock in the S&P 500, but a rising clean surplus ROE. Now, here is the kicker. When we know that a company is taken private and then put out to the public again, it usually has a lot of debt. And let's go over here to the years to pay debt. And remember, the magic number is 5. And years to pay debt means that if the company took all the money it was making and put it back into the company in order to pay the debt, how many years would it take? And Buffett's rule of thumb is 5 years or less. Our rule of thumb is 3 years or less. And here it is. It takes 12 years if the company is taking that money in order to pay off debt. Now, the net income is going up, so this may reduce the years to pay debt as long as it can keep growing. But the market looks at this debt and it says, I don't know about buying this stock. So, folks, right away, number one, the ROE below 20% says this stock is not going to be in our portfolio. But then we look at that rising ROE, which means the earnings are increasing at an increasing rate. In other words, they're accelerating. But then we look at that debt and we look at 12.6 years and we say, no, not in our portfolio. This could turn out to be an ugly stock if we go into recession and this company cannot make enough money to pay off that debt. And here we are looking at the performance of this stock over the past 3 years, and we can see that this stock has been all over the place. Black line is the S&P 500, and we can see that with the S&P 500 over the past 3 years up about 50%, this stock is up about 20%, so it's lagging the market, but still positive. It's doing fairly decent out there. Okay, Debbie, what is our next stock?
All right, the last one is one that I'd never heard of, but it was sent in by one of our listeners out there, and that stock is Heico, Heico. They engage in the design, manufacture, and sale of aerospace, defense, and electronics-related products and services. And it operates in two segments. The first is the Flight Support Group with 63% of sales, and they design and manufacture jet engine and aircraft component replacement parts. And the Electronic Technologies Group, which is 37% of sales, manufactures various electronic, microwave, and electro-optical products.
Wow.
Interesting.
That's a mouthful.
Have you ever heard of that, JP?
Well, actually, I did, but I had no clue what they did. So, and in looking at this stock, let us look at the numbers. And we can see that the clean surplus ROE is above the average stock in the S&P 500. So we would expect this stock to do better than the average stock in the S&P. And you can see that it is also rising, or has been rising up until this year, but projected to drop a little bit for next year. The one thing that we want to look at is revenue growth over here, and the revenue growth is about 4.6%, so it's starting to slow down. Well, this stock is a pretty good stock, and we would expect it to be outperforming the S&P 500 with that rising ROE and the ROE above the average stock in the S&P 500. And looking at the last 12 months, we can see that definitely this stock is outperforming the S&P 500, with the S&P up about 17%. This stock is up 70%. And when we look over the past 5 years, we can see that this stock was just chugging along with the S&P 500 over the first 3 years. And then last year it started to take off, and this year is doing exceptionally well. And looking back at 2018, we can see that from 2017 to 2018, this stock took a large jump in that clean surplus ROE, which meant the earnings really went up a lot, and the market liked that. And of course, right now the present administration is favoring the aerospace and defense industries and putting money into that area. We just have to be careful to make sure this is not a cyclical stock in case we begin to go into a recession and they start to sell off a stock like this. So we have to be careful. But other than that, it's pretty good. If times remain good, then this stock is going to keep going up. And then when we look at all three stocks together, we are looking at the clean surplus ROEs. And here's the S&P 500 at 14.5%, with Heico up about for 2019, up about 17.2% with a rising ROE. Salesforce.com with an 8.3% ROE, below that of the average stock, but that ROE is going up. The market likes that. And then we have Hostess with a 7.6% ROE, which is the lowest in this group. With a rising ROE, we like that. However, the debt is about 3 times higher than we like to prefer in any stock that we buy. So we wouldn't buy this stock just because of that high debt. If there is ever a hint of recession, this stock could go down drastically. So we don't like that high debt at all.
Egads. Woo.
And looking at the chart of these 3 stocks over the past couple of years, we can see that Heico is leading the group with a gain of 270% versus the S&P 500 of 50%, which is this black line. So Heico is this top yellow line all the way up here, and then Salesforce.com would be the second stock, and indeed it is. And then we have Hostess, which is lagging the S&P 500, but still up about 20-25% over this time period that we are showing.
Alrighty then, JB. I think we've just about covered all the questions and then some that were sent in by our listeners out there in investment land. And remember, we're here to answer your questions not only about individual stocks, but also about the stock market in general. So keep those questions coming. And who knows, we may even answer a question or two you didn't even know you had. That's about it for today, JB.
Okay, don't forget, if you want to receive a full month of all our letters, free, folks, just go to our site.
Everybody loves that word.
And sign up. It's BuffettandBeyond.com, and Buffett is spelled with 2 F's and 2 T's. That's BuffettandBeyond.com. Okay, folks, we had a great day today.
Tomorrow will be even better.
All right, bye, folks. We'll see you next time.
Bye, everyone.
And remember, folks, if you want to live on the beach like Jimmy Buffett, you've got to learn how to invest like Warren Buffett. We've had a good week, folks, and here's hoping that next week will be even better. You have a safe weekend, and we will see you next time.